Welcome students. So in the process of learning about the financial estimates and projections, now we will talk about the next component, and the next component of the financial estimates and projections of a project is the working out of the cost of the project. So while working out the cost of the project means, what do we mean by the cost of the project? It is particularly, you call it as the cost of the project represents the total of all the items of outlay associated with the project which are supported by the long term funds, right. This is important for us. The cost of the project represents the total of all items of outlay. All items of outlay means the fixed asset expenses associated with the project which are supported by the long term funds. So important components are long term funds, and second thing is the items of outlay. It means when you want to give the shape to the project, you need long term assets, you need fixed assets, and sum total of the fixed assets is going to give us something which we call it as the project, or which we call it as the venture. So some of the outlays. So it means when we are going to build that project, when we are going to build that the venture, because all preliminary works have already been done, and now we are going to give shape to the project or to the venture, and after that the production will start. So in this process we need to have certain long term assets, fixed assets, because total structure of any venture, any project is having two kind of the assets. One is the fixed assets or the long term assets, and second one is the current or the short term assets. So long term assets start with the land and many other assets which have a life of more than a year. They are called as the long term assets, or they are called as the fixed assets, and we need the long term funds for supporting those assets or procuring those assets and bringing those assets in the project. So we need the long term funds for that. And after that, once we have already built up the project, we have already incurred the project outlay, or the cost of the project has been worked out or has been incurred even. After that, we have to look for the short term funds for supporting or for finding out the short term assets or the current assets, which largely maybe are the assets which are required only for a period of 1 year or for a period of 12 months. For example, you need the raw material, you need the labor, you need all utilities, you need all auxiliary materials, right. All these are called as the current assets or the short term assets, which need to maybe to be utilized, or maybe required in the firm or in the business or in the project for the proper utilization of the long term or the fixed assets. So this is a sum total of two kind of the assets, long term assets and the short term assets. So first we will give the shape to the project, and largely when you are talking about this kind of the project, we are talking about a manufacturing sector firm. Even in the services sector firm, maybe sometime the long term assets are not required that much as they are required in the manufacturing sector firms. So if you want to manufacture any product, whatever it is, it's going to be, you need the long term assets, and you need to commit the long term funds on the long term assets. And those long term assets are going to be, fixed assets are going to be land and site development. We need the funds for that. So first of all, it means you have to buy the land where you want to erect the sheds or maybe the project buildings. For that purpose, you need the land, and if you are going to acquire the land, so it's going to be long term assets, but you need the funds for that. And for acquiring the long term asset like land, you need the funds from the long term sources, so long term funds are required. And then once we have procured the land, we have acquired the land, now we have to go for the site development. Maybe it may not be directly usable chunk of land, we have to make it usable, we have to develop the site. So for the site development also we need to have, or mean we need to spend funds. So again it is requiring the long term funds, because you are developing a long term asset. Then you talk about the buildings and civil works. So once the land is available with us, it is fully developed. So after that we have to go for buildings and civil works, and you need to incur the fixed say cost, or maybe the long term funds for building erection and construction and doing the civil work. So you need the funds for that. After that you need the funds for plant and machinery, which is going to be now housed in that building which has been constructed on the land which we have acquired for developing or maybe setting up that venture. And after that we talk about the technology, which is called as technical know-how and engineering fees. So it means you have to pay for technology. Technical know-how means you have to pay for the acquiring the technology plant once you are going to build up. So plant might have the two components. One is the hardware and second is the software. So software is basically a kind of a technology. You have to pay for that, and again it's a long-term component. So you need to commit the long-term funds, and at the same time, people who will build that and who will bring the technology, install the technology and technical know-how, they'll be requiring or they'll be paid some charges, engineering fees. So it's on the long-term asset, so it's again a long-term component. Then next thing can be expenses on the foreign technicians and the training of the Indian technicians abroad. So any technical manpower, for example, initially if they supply us machinery or maybe technology, and initially those people come to India and they stay here, so we have to bear their expenses. And later on it may be possible that some of the Indian manpower or maybe the workers or technicians, they have to be sent abroad. So their training expenses are again going to be a long-term expense and would be the part of the cost of the project. And apart from the land, plant, building and machinery, you need to have other miscellaneous assets also, which may be called as furniture. You need to have vehicles, you need to have any other kind of the other fixed assets. So all those miscellaneous fixed assets need to be created, need to be built, and for that purpose also we need the funds. After that, we talk about the preliminary and capital issue expenses. So preliminary and capital issue expenses are something kind of that preliminary expenses are miss on the multiple accounts. First preliminary expense you are going to incur is on, say, preparing the project feasibility report. Even sometimes we spend some money on generation of the project idea. So even before giving shape to the project or maybe selecting one idea out of many, we have to incur some expenses on the idea generation and then selecting one idea out of many. And then we have to go for preparing the DPFR, detailed project feasibility report. So we have to pay to the consultants or to the firms with whom we are working with and preparing the DPFR. We have to pay for conducting the market survey, market and demand analysis. We have to pay for conducting the technical analysis and even for the financial analysis. So all these expenses are called as the preliminary expenses. So you mean to say that preliminary expenses are sometimes incurred for those ideas also which we are not going to give shape at the later stage. We may drop those ideas because when we prepare the DPFR or maybe at the initial idea generation stage, we found that not very lucrative idea, and even when we prepare the DPFR, the outcome of the DPFR was not maybe a supportive, say you call it as an outcome, and finally we decided that if you move into this kind of the venture, it's not going to be a win-win situation. So we drop the idea even after incurring the preliminary expenses. And sometimes, for example, if we say go for incurring these expenses, we go for idea generation, we spend some money, we go to consultants, we talk to them, take their advice, we prepare the DPFR, everything goes well and net result is also very positive. We conduct the market and demand analysis, we conduct the technical analysis, and the result is very possible. So in that case, your preliminary expenses would be used, and tomorrow later on, for example, you have to maybe give shape to that project. So you have to get it give shape in the form of a some venture. Either it will be a company form or maybe a partnership form or maybe a sole proprietorship. If it is a sole proprietorship, so not much, maybe you call it as a documentary expenses are required to be incurred. But even if it is a partnership firm, you have to prepare the partnership deed, you have to get it registered, so you have to pay for that. And if it is going to be a private limited company, so you have to create a company, you have to get the company registered, and you have to prepare the initial documents of the company, which is called as memorandum of association, article of association. So for that purpose also you need to have that all the documents, you have to get it prepared from the people and you have to pay for that. And tomorrow, for example, if after some time you convert that private limited company into a public limited company and you want to raise the funds from the through stock market, or maybe you want to go to the stock market or get the company listed in the stock market by converting that private limited company into public limited company. So you have to incur the capital issue expenses, you have to prepare the prospectus, you have to go for the say all these merchant banking operations, and you have to maybe say fulfill all the requirements of converting the private limited company into a public limited company. So for that purpose also you need to incur some expenses. So at different stages, maybe sometimes some preliminary expenses are those when the project is only on the paper and nothing has happened on the surface, so you need to incur some expenses. And some preliminary expenses are those when we have decided to go with the idea, set up a venture and then give shape to that venture. So for that purpose also we need to go for the incurring of the preliminary expenses. After that we talk about the pre-operative expenses. So there is a difference between the preliminary expenses and pre-operative expenses. Preliminary expenses are largely when the project has not been given a shape, and the pre-operative expenses are those expenses when we have decided to go ahead with the project, and for initially you call it as for maybe making the say piece of the land, you call it as usable, or maybe erecting the boundary wall, or maybe going for some training of the people, or maybe some other kind of expenses which are to support the maybe coming of that venture into existence. So these pre-operative expenses are those expenses where we have already decided the say setting up of the venture, we are already building the project, and we are incurring some expenses before starting the production. So any expense which is before starting the production or maybe facilitating the overall setting up of the venture, they are called as the pre-operative expenses. Then we have to talk about the next amount of the cost of the project is the margin money for working capital, because normally there are multiple sources for getting the working capital. We can get the working capital from the commercial banks also, we can get the working capital even from long term funding also. And there is an inbuilt clause these days that if you are able to have long term funding from development finance institutions or maybe from any investment finance institution, if they are ready to invest in your project, and for example they give you some maybe 2 crore rupees or 3 crore or 5 crore, 10 crore rupees if they give you as a loan. So there is an inbuilt clause that maybe 10 to 15% of that total long term funds the firm can use for the short term purposes or for the working capital purposes. So for that purpose you don't have to seek permission from the lender that can I use part of this money for the short term purpose or not. So that money can be part of the long term funds can be diverted for the short term requirements. That's the one part. But largely in India, the process is that the working capital finance generally comes from the commercial banks, and commercial banks do not give you 100% working capital finance. They give you in certain proportions. So maybe maximum they can give you in the ratio of 80-20, that 80% they will give you and 20% the venture has to bring it from its own sources. Entrepreneurs have to bring its own sources. So that margin money is also required. That 20%, 20, 25%, 30% of the money is also required to be brought in from its own sources, which is called as a margin working capital or margin of working capital. So because no source is going to provide you 100% working capital finance. So for that purpose, you have to have the funds from your own sources and you have to make provision for that. Either you divert the long term funds for short term requirements, or you raise the funds from your internal sources, whatever it is. But that is also a component of the cost of the project, and we have to provide the funds for that. And then we should have sufficient funds initially for the initial cash losses, because from the first year onwards we are not going to earn the profits. We are going to earn the profits, as I told you in the previous lecture also, after crossing the break-even point. And break-even point is a point of no profit, no loss. And in the first year, certainly no firm reaches at the break-even point. Maybe it reaches at the end of the third year or the fourth year. So initial 2-3 years period of time, you need to have those funds to fulfill those cash losses. So because certainly the cost will be more, the returns will be less, revenue would be less, and maybe the selling price would not be up to that much, sales will not be up to that much. So certainly there will be a negative difference between the cost and the selling price or sales value. So there would be you call it as the situation of loss. And for making those losses good, you have to have some cash or some funds available, which you have to support the project in making their losses good for initial 2 to 3 years. So for that purpose you need to have the funds. So all these sources, they require maybe the funds, and sum total of this we call it as the cost of the project. Largely they are the long term in nature, because they are required for building the long term assets: land, building, plant, machinery, other assets like furniture, vehicles, patents, copyrights. All those, maybe some are physical assets, some are not physical assets. So for those building those assets, right from the land till plant, machinery, technology, human resources, training of the human resources, everything, we will have to have the funds from the different sources, and maybe all the requirements will be met from the long term funds. So long term funds is a one important thing, which is the total outlay of the project which we are going to incur for building up of that project, and this sum total is called as the cost of the project. So under financial estimation projections, we will have to have the very clear idea that how much land we are requiring, what is the cost of that land, what size of the buildings are required, how much plant and machinery expenses are going to be there, how much technology expenses are going to be there, on training of the human resources, how much expenses are required to be made, how much is required for miscellaneous fixed assets and preliminary expenses, pre-operative expenses, margin money for the working capital and initial cash losses. All this is required to be estimated in advance, so that we are able to arrange the required amount of the funds from the different sources, largely from the long term, and we are able to fulfill the long term requirements of the venture or the project as a whole. So this is the first important component for say building up of a project, and financial estimation projections talk about all these long term assets which are generally long term in nature. Then we talk about the means of financing. Now once we have decided to go ahead with the project, right? Once we have decided to go ahead with the project, so we have normally two kind of the decisions to be made. First is the investment decision and second is the financing decision, right? First is the investment decision, second is the financing decision. So in the investment decision, we decide about in principle that yes, we are going to make investment into that venture. Idea is acceptable to us and we are going to make investment into that idea, and we are going to build that venture as a whole for maybe giving a shape to that startup, or maybe a new project of existing firm or anything. We are going to build that project, right? So that's the investment decision which we take in principle. We accept the idea. All the say initial you call it as the assessments are positive, giving the positive results. DPFR is giving us the positive results. Then your market and demand analysis, technical analysis, even the financial analysis, they are giving us the positive results, and finally we are going to make that investment. So that is called as the investment decision. Second decision is called as the financing decision, and for the financing decision you have to you have to go ahead with the say deciding about where the funds will come from. Means how the financing of the project or the requirement of the financial requirement of the project would be made good, and from where the funds would come. That is called as the financing decision. So when you talk about financing decision, because the investment decision has already been taken, so now you have to go for financing decision, that how to finance the venture or this or the project as a whole. So for that purpose you have to understand very clearly that what are the different sources of the funds available around us, which are in maybe in our say you call it as access, and we can maybe make use of those funds. So means of finance we have to clearly understand, and finally we will have to arrange the funds from those sources. So as it is written here that to meet the cost of the project, the following means of financing are available, right? Following means of financing are available. So it means when you talk about these means of financing, so first of all we talk about the first means of financing is the share capital, right? Is the first means of financing is the share capital. Now the question arises is, share capital is not possible to be used in all kind of the ventures. Share capital is only possible to be used for the public limited companies, right? When you are going to get the project or maybe your venture listed in the stock exchange, you are going to register the company or that organization as a public limited company, then you can have the share capital in the real sense, means in the true sense, in the literary sense. Share capital is the funds raised from the general public by issuing the equity to the general public by following a equity issue process, which is normally through IPO, initial public offer, and later on through the FPOs, followed on public offers. So this is the one source, share capital, but not available to all kind of the ventures. And if it is a startup, for example, and maybe it's registered as a partnership firm or maybe as a private limited company, then certainly the share capital is not available to the private limited company or the partnership firms. There only you have to access the different sources, like you have to go to the venture capitalist, you have to go to the angel investors, you have to go to the private equity providers, and you have to decide that how many members in that company are going to be there, how many partners in that partner firm are going to be there, and what is their respective, their own contribution, because initially you have to arrange the funds from your own sources, and then for the remaining requirement you have to look towards the external sources. So how much is your investment going to be? As a partner, how much you are going to invest in the firm, or as a member of a private limited company, what is going to be your shareholding, or the respective share and the respective share of all the members, all the owners of the company, their private limited company. So in that sense, we call it as a share capital. If it's a private limited company, it means share capital would be the contribution of the members of the company or the owners of the company, or the entrepreneurs, group of the entrepreneurs who are going to be them member of that private limited company. If it's a partnership firm, so it's a contribution of the different partners in that certain ratio. So their contributions. So you call them that as a share capital, or you call that as a internal source of the finance, but that's not a share capital. Share capital is basically, maybe you can say that it's an internal source of the fund, but in the true sense, share capital is only available to the public limited companies, to other forms of the business organizations, maybe private limited company or partnership firms. The amount of the funds brought in by the owners of the partnership firm or the private limited company is called as the internal source of the fund, and for the sake of understanding, you call that as a share capital. Second thing is the term loan, right? Term loan is basically the external source of funding, means through the borrowings from the market, we can generate the funds in the form of the term loans, or by borrowing the funds from the different sources, maybe from the financial institutions, maybe from the banks, or maybe from other organized source of funding. So that's called as a term loan, or the external source of finance, or maybe the borrowing from the external sources of funding, which is called as a term loan, and it's basically the external source of finance. Similarly, the debenture and bond capital is also there, and debentures and bonds can be issued by the companies, and maybe they can raise the funds. Again, it's a debt on the company. Funds raised through debenture and bonds are the external sources of the funding. They are also lending on the company, or maybe borrowings by the companies from maybe the individuals who subscribe to the debentures of the companies or bonds of the companies, or maybe institutions also. Sometimes institutions also subscribe to the debentures or the bonds of the companies, but it's again a kind of external source of funding, and maybe call it as the lending by the individuals or by the institutions. Then we have the deferred credit, right? Deferred credit is something like that when we buy the plant and machinery, means for the fulfilling the long term, or say having the long term assets in the firm, for fulfilling the long term assets requirement in the firm. When we buy the assets from the companies, say for example some companies supplying us the technology or plant and machinery or furniture or vehicles, or maybe some other important fixed assets, long term assets. So they may not require the payment of immediate funds, or you may pay them initially 5-10% of the total cost of the asset, and remaining 90 to 95% of the cost can be paid at the later date, which is called as a deferred credit. It's not to be paid immediately. So if it is possible, we can use the deferred credit if it is available to the firm. Then are the other sources, incentive sources, which is seed capital, capital subsidy, tax incentive and concessions. Largely these sources come from the government, right? These sources come from the government. So sometime government to support the industrialization, or sometime to support the employment generation or industrialization in any particular area, or to deal with some kind of the problems and to generate the employment. Maybe some problems, for example, nationalism, or maybe you call it as some antisocial elements, because they're involved into such activities because they are unemployed. So to create the fruitful and unemployment in those areas, disturbed areas, government sometimes encourages the industries that if you come and set up the industrial units here, we will give you the say some incentives, and we will give you the seed capital. Seed capital is basically a kind of a loan which has to be returned by the firm later on to the government or maybe to the funding agency. Capital subsidy is something like which is a permanent support and it has not to be returned. So it's from the government's side. It's a government's contribution for that project. Tax incentives and concessions are there. Many a times that tax concession and incentives are announced by the government to support the industrialization in any particular area, maybe it's a district or a state or any particular say territory which the government want to support. So the incentive sources also provide sufficient amount of the finance. Then we have the miscellaneous sources, which are unsecured loans, public deposits, leasing and hire purchase finance, and some other sources. But they are normally available for the short term purpose, not for the long term purpose. Unsecured loans are also available for the short term purpose of financing, because long term financing cannot be done by any source, any institution, without any kind of the collateral, without any kind of the security. It's only for a period of short term or for meeting the working capital requirements or short term requirements. Unsecured loans can provide us the credit. Public deposits are also borrowings by the companies by issuing the deposit certificates to the public, but they are also short term. In India, these deposits can be raised only for a period of 6 months. So for meeting the short term or working capital requirements, you can raise the funds through public deposits. Then we have the commercial paper, we have the factoring, or so many other sources are there. Leasing and hire purchase finance is also there. But all these sources, when you talk about the miscellaneous sources, they are only providing us the funds for the short term purpose, right? They are only providing the funds to us for the short term purpose, not for the long term, right? For the long term purpose, you have to have these sources where you can use the share capital, you can use the term loan, you can use the debentures and bond capital, you can use the deferred credit, and you can use the incentive finance from the government, right? For the short term purpose, this is the last source which is available, and we can raise the funds from this source. So firms require funds for both the purposes. Firms require the funds for the long term purposes also, for the short term purposes also, because they have to raise the fixed assets also, they have to raise the say short term assets also, current assets also. So different sources of the funds are available here. But now the $1 million question here it is, these means of financing when I am talking to you is, they are available only to the firms who are going to have new ventures, new projects, and who are going to expand their business in the form of expansion, diversification and growth, right? For them, even the share capital can also be available, term loans can also be available, debenture and bonds can also be made use of, and deferred credit is also available, because they are already into existence, they are already into the business, right? And their say maybe credibility has been established, people know them, and maybe they are existing institutions and they have proven their financial might and their credibility in the market. So for them, maybe going for a new venture, new project may not be a challenge, that you can easily raise the funds from all these sources for long term as well as the short term purposes. So this is all for the existing, when the firms have to go for the say expansion, diversification or growth of their business activities. But what about the people or maybe the ventures which are going to come up for the first time, right? They are startups. When you talk about that India has 117 or 120 say unicorns, it means they were startups at some day. They were started by some individuals, young graduates, and they have maybe worked hard and they have taken them to a level where they are today known as the unicorns, or they are called as the decacorns. And if total number of the startups we talk about, they are close to 160,000 startups which are recognized even by the government, DPIT, right? So it means when we are talking about the startup finance, or we are talking about the new venture or new project finance, which is not a project by an existing medium or the large scale organization, but by a group of the young graduates, for them what are the means of financing? For them, for the startups, the means of financing are, first of all, as I told you in the beginning, because share capital is not available, so your own contribution is the first source of the finance. So if for example 2-3 people join hands, So they have to decide that what is the total investment requirement for their venture and how much is the total requirement is. For example, the total requirement is 100 lakh, right? So in this total 100 lakh rupees or maybe 1 crore rupee which they are going to invest in that venture. So it means how much they have in their hands. So each one of them, there are 3 people and they can invest, for example, say they can invest the 30 lakh rupees from their sources. So remaining for the remaining amount of the 70 lakh, right? 70 lakh of the funds has to come from the some other sources, and for that purpose now they have to look for the source. So can they make use of the share capital? No, they cannot make use of share capital because it's a startup. Term loans are also not available to them because financial institutions do not know them. Similarly, debentures and deferred credit, all these things are not available for them. So what they have to do is, for search of this 70 lakh rupees, they have to go to the different sources who support the startups. And they are, we all understand, they are angel investors, or they are the you call it as the venture capitalists or angel investors, and maybe some private equity providers. So you have to go to them and talk to them. So they would, if they listen, if they find your idea interesting, in that case they would be ready, but they will ask you to give the detailed presentation. And for the detailed presentation, maybe they have to ask you number of questions on the DPFR, detailed project feasibility report, and they will ask you that how you conducted the market and demand analysis. Maybe first they will ask that how you generated this idea, what was the rationale behind it, that you are going to manufacture this product or raise this service, or maybe going to come out with this kind of the business activity. What is the source of your idea, how you have generated the idea, and how you have zeroed it on. And then they will go for that. Now you show us that how you conducted the market and demand analysis, where is the market for your product or the service coming out of your venture, and how you substantiate this market and demand analysis, who conducted this market and demand analysis for you, and similarly what is your technical analysis outcome, how much investment is required, what kind of the machinery is required, what kind of the the structures are required, what kind of the other fixed and maybe the short term, long term and short term assets are required. All these kind of things they will ask you, and later on they will ask for the financial projections. They will say that show us the projected income statement, cash flow statement and balance sheet. So if they feel convinced that yes, the project has some kind of the reasoning or some kind of the, you call it as maybe logic, that yes, this kind of the venture can be set up, people may like the outcome of the project, maybe a project or maybe a product or a service or maybe anything coming out of it, then they would be ready to come forward and to finance you, to provide the funds. So this 70 lakh can be generated from the angel investors or from the venture capitalists. But their terms and conditions are very strict. They sometimes participate in the management of the business also. They don't give you simply the money. They participate in the management affairs of the firm, and whatever the returns they require on this 70 lakhs, their cost of funds is also very high sometimes. Maybe if they are giving it in the form of the debt, the interest rates are also very high. If you are giving there in the form of the equity, so they expect a high amount of return. So you have to be very much prepared for that. That initially we will have to bear all this, all the dictums of the maybe the fund providers or our investors. And later on, when we will become self-standing institution or maybe organization, we start earning the profits, and then we will maybe sustaining in the market, and we will start growing in the market. If we get sufficient funds, we will pay the all their investment back along with the interest or maybe the dividend or whatever it is. And after their exit from the business, we will replace those sources of the funds with the maybe the established sources of the funds, like your share capital or maybe term loans or debentures or deferred credit and all that. So this all will come to you maybe either in a situation, if you are an established organization, established company, and you are going for expansion, diversification and growth. If you are a startup, then initially these things are not available to you, right? So you have to start from this process, and after passing through all these hurdles, these processes, once you have established yourself in the market as a startup, you have started growing, you have become profit making, you have proved your might in the market, then only you can think of raising the funds from any of these sources, and then you can give them an exit to the initial investors who are angel investors or the venture capitalists. So they will take an exit and you can replace their funds from with the established sources, and then the cost of funds will also come down. You will get the funds on the regular basis from these established sources, and then the firm will start growing and start doing well in the market. So means of financing is a very important consideration, very important discussion, but for the different organizations, different sort of the businesses, different sources of the funds are there, different means of finance are there. So we have to decide first of all at what stage of the business we are, at what stage of the business our venture is, and what source of the financing would be useful for us. Only then we can decide about raising the funds from the different sources. So with regard to this say financial estimation and projections, we have so many other things to discuss, but at the moment we will stop here, and further discussion on the say this financial projections we will have in the next class. Till then, thank you very much.